Risk off is still growing among European banks. Not only are they still piling into government bonds, a key reason why is they're increasingly concerned about the economic state of Europe's consumers. They've been tightening lending standards with a particular focus on consumer loans. And this isn't because of tariffs or trade wars, it's entirely a product of fears over the economic direction of Europe's labor market. The ECB just released the results of its second quarter bank lending survey, and it is consumers that institutions over there are increasingly most worried about. Tightening in lending standards related to them were, quote, driven by concerns about the general economic situation and borrowers' creditworthiness. This has become an entirely too common expression among banks all over the world. And that means that they're more and more focused on incomes and job prospects, just like consumers are. Even a modest tightening in consumer loan standards is a warning sign that the information on borrowers that banks are getting is deteriorating, as the survey says. These prospects are driving bull steepening on European bond curves, with markets looking for the next step to ratchet rates lower, as it looks more likely the economy will itself get ratcheted down even further. And up to this point, Europe, like a lot of other places, has managed to navigate the forgot how to grow economy of the past few years without suffering the full retreat in its labor market. Yeah, they've seen the same painful lack of hiring, but so far, no big spikes in unemployment outside of places like Germany. And even there, joblessness has been more like the proverbial boiling frog, slowly yet steadily rising, and that's the fear across the European financial landscape. And so the economic temperature across Europe is still rising, but in this case, we're not talking about hot as in inflation. Instead, European banks continue to prepare for, first of all, lower interest rates, but more importantly, what lower interest rates truly mean. And I don't mean, nor do the European banks, that it's stimulus. Low rates equate to low growth and low inflation expectations, and a transition from where we are today, forgot how to grow, into that lower interest rate state. So the ECB put out its bank lending survey results for the second quarter of 2025. And in it, it said, banks are reporting a slight net tightening of credit standards for loans to households for house purchases, and a more pronounced net tightening for consumer credit and other lending to households. In fact, that was a net percentage increase of 11%. For both housing loans and consumer credit, changes in risk perceptions and the risk tolerance of banks were the main drivers of the net tightening of credit standards. And for the third quarter of 2025, looking ahead, banks expect credit standards to remain unchanged for firms, meaning businesses, to ease slightly for housing loans, but to tighten further for consumer credit, even more than it already has. And as I said in the introduction, the net tightening impact of risk perception was driven by concerns about the general economic situation and borrowers' creditworthiness, especially in places like Germany and France, Europe's two largest economies. This factor was reported mostly by banks in those countries. The main factor contributing to a net tightening of credit standards in Germany was risk tolerance, or the lack of risk tolerance. So European consumers so far have been able to avoid the worst cases as far as the labor market goes, mass layoffs and things like that, even though they've suffered for years under forgot how to grow and the lack of employment, lack of hiring. There's this concern that conditions, the temperature will continue to turn up on the boiling frog, and the European economy and European consumers are going to continue to absorb more and more economic pain. And if you're a bank in that situation, the last thing you want to do is to extend consumer loans, among the riskiest things that are out there, in a situation like this. As the ECB's report said, perceived risks related to the economic outlook continue to contribute to a tightening of credit standards, whereas competition had an easing impact. For the most part, banks reported no specific additional tightening impact on their credit standards related to geopolitical uncertainty and trade tensions, although they intensified their monitoring of the most exposed sectors in firms. So again, they're saying it's not tariffs, it's not trade wars, it's pure economics. It's several years where the economy has failed to grow, which is itself a contraction, and the growing concern that having failed to grow for several years and no change in sight, that there is a rising probability that the increasing worst cases actually become more and more probable. And in the second quarter of 2025, Euro area banks reported a slight net increase in demand for loans or credit lines to firms, With demand, however, overall remaining weak. Despite the fact the ECB has cut rates, it doesn't actually matter. And the report continues, loan demand was supported by declining interest rates a little bit, but dampened by global uncertainty and trade tensions, which they just said was not a big consideration for the banking sector. Instead, economic considerations were. And Euro area banks reported that non-performing loans, or NPL ratios, and other credit quality indicators had a net tightening impact on their credit standards across all loan categories, as well as a net tightening impact on terms and conditions for loans to firms and consumer credit. And banks expect these trends to continue in the third quarter for loans to firms and consumer credit as well. And that's about credit quality. So banks are saying, even if we wanted to lend to you, we're not going to be able to do so because your credit score, your job history, your income prospects just are not going to allow us to do so. So again, it's economic deterioration, not related to trade wars, but just forgot how to grow that is potentially forgetting even more how to grow across Europe as well as outside of Europe. And one final note from the bank lending survey from the ECB. The ECB's bank reserves just don't matter. They don't matter. In fact, the report says so. Banks indicated that changes in excess liquidity, that's what they're talking about the ECB's bank reserves, held with the Euro system in the first half of 2025, had a neutral impact on bank lending conditions. They expect to see similar effects in the second half of 2025, which is, it doesn't really matter what the ECB's balance sheet looks like or how many bank reserves are on it. What banks are focused on are the fundamentals of the European economy as they relate to the entire global economy. We don't mean trade wars and trade tensions and tariff sentiment. What we're talking about is macroeconomic deterioration and the fact that there is zero upside and there's more and more of a defined downside, especially as it relates to jobs and incomes and therefore consumers. Even European banks are saying, well, I think we probably need to cut back here. And before we get back to the rest of our video, check out Eurodollar University's new subscription service over at Substack. In it, we're going to give you the biggest topic every single week and then all of the relevant details surrounding it so that you can understand what's really happening and, more importantly, why it's happening, all from the Eurodollar University perspective. So check out our new Substack subscription service. There's links in the description of this video. We also have other anniversary sales going on for Eurodollar University memberships. Details for that at our website, eurodollar.university. As it is, it's not like the European banking sector has been out there handing out loans to everybody who shows up. Lending has been relatively weak. In fact, it's been incredibly weak ever since the Forgot How to Grow economy started up back in 2022. Now, it did pick up in absolute terms in the middle of 2023, heading into 2024. But it's a rounding error at this point. It's bank lending is growing, but it's not actually growing. It's the lack of growth that defines everything. In fact, it's growing so slowly that it's actually being a contraction. European bank lending is growing in absolute terms, but in any meaningful standard, European bank lending, therefore the European economy, is falling further and further behind. That's the Forgot How to Grow dynamic. You can see this across the European banks' lending book. Going back to the beginning of this year, total loans across European banks increased by 207.2 billion euros. And while that maybe sounds like a lot, it is not. It's only an increase of 1.4%, which is, again, well below what Europe would experience under a period where European banks are operating more in line with normal conditions in a healthy economy. And of that 207.2 billion, only 84.4 billion is in loans extended to non-financial corporations, which are commercial businesses, as well as households. Those two categories combined. Basically, the entire real economy only got a little bit more than a third of the total increase in loans. That's a 0.7% increase. And to just non-financial corporations, loans only increased 30.5 billion in the first 5 months of 2025, a 0.6% increase. Instead, European banks have been lending to the other loan category, which includes some government borrowers. The loans there increased by 42.0 billion, or a 3.8% rate. And of course, they've been lending to investment funds, or these shadow banks, an 80.8 billion rise in lending to them this year, or a 5.7% rate of increase. So even in their loan book, overall, it's not really growing. And where it is growing, it's growing in lending to other quasi-governments and government agencies around the European continent, as well as lending to shadow firms, which is taking some risk, but keeping it what European banks hope is at arm's length. So not a whole lot of risk taking. And with lending standards, especially to consumer loans, set to rise even more, and European banks increasingly wary about consumers as borrowers, this is only going to get even worse moving forward. Now, what European banks have been doing and where they have been putting their balance sheets, government bonds. For the first 4 months of this year, they went on an epic bond buying spree that only slacked off a little bit here in May, but for the first 5 months of 2025, European banks' bond holdings increased by a whopping 233.7 billion euros, or a 13% increase. They added more government bond holdings to their balance sheets than they extended total loans. And going back to January 2024, when things really got started, when this risk aversion really started to show up across European banks, total bond holdings have increased by 450 billion, a 28% increase. What is that? Roughly 16 months since January 2024. Meanwhile, at the same time, loans to the real economy during the same period, going back to January 2024, only increased by 227.9 billion, or just 1.9%. That's barely a percent a year rate. So bank lending to the real economy, that's out. While it's growing, it's growing in absolute terms, it's not actually growing. It's falling further and further behind us, so the European economy is. Meanwhile, European banks are piling into government bonds, all because they are defensive for economic reasons that have less to do with tariffs and trade wars than everybody seems to want to say. So with all of this defensive behavior across the European financial sector, especially the banks, of course, interest rates are going to be bull steepening across the European bond curves and the European government bond market. As of today, Germany's 2 years rate around 1.8%, where it's been pretty steadily over the last several months. Most people have focused on the 10-year, which is back and forth, just like the U.S. Treasury 10-year is. As of today, it's 2.6%, but that's still the same bull steepening that we observe in Germany as elsewhere across the global bond market, like U.S. Treasuries. In fact, you go back to all the way back to 2023, and you can really see this bull steepening process develop through time. As the European economy first forgot how to grow, experienced a banking crisis, and then got even worse afterward, the inability to get out of this rut. Germany's 2-year hit its high rate actually the day before Silicon Valley Bank failed. That's another piece of evidence that the banking crisis in 2023 impacted the entire world, and we are still living in the consequences of it. But after the banking crisis in 2023, while policymakers and politicians declared it an all clear, the German curve saw the 2-year flatten out between July and September, even as interest rates were rising and the rhetoric continued to get hotter and hotter about higher for longer. The German 2-year said, no, that's not happening. We've hit the terminal rate, the terminal high rate already. And then the first drop in the 2-year, consistent with the bond rally in late 2023, it then leveled off to the spring of 2024, back when we had the sticky inflation. The ECB wasn't sure if they were confident over consumer prices. But then the 2-year dropped again with the recession scare last summer into October. And then despite the inflation scare that developed at the end of last year, the 2-year shots were basically stable in late 2024 and into early 2025. And then the next big drop came in March and April, consistent with the tariff shock, but really the consequences of the global economy experiencing that fragility coming to the forefront. And ever since April 2025, just like swap spreads, the German 2-year has remained largely steady the entire time. Likely waiting for the next step down, likely waiting for the next catalyst that will trigger the next step down in short-term interest rates. And then the ECB comes along behind them and follows it up later on. So you've got Germany's 2-year and two-year maturities all over the global bond market that are increasingly in this bull steepening process. You can see it happening over the last couple of years. You can see it developing, and it hasn't ended yet. And of course, the other part of that is the steepening process, the steepening part of the process. This is not unusual, even though everyone is jumping on debt fears, saying that rising long-term yields are related to rejection over government deficits and government debt issuance. It's not the case. The curve is bull steepening. We saw this back in 2008, 2009, and the reason we bring that up is because it's the most extreme example that really illustrates the point that I'm making here. Yields overall on the German curve, they dropped sharply like everyone else's did in September and October 2008 during the crisis, but short-term rates fell farther and faster during it than long-term rates did. There's again the bull steepening. But from the middle of December 2008, short-term rates kept going down to near zero by February 2009. Meanwhile, from the middle of December 2008, and this is true not just in Germany, but in US Treasuries and other markets around the world too, longer-term rates were sideways to higher. That was the dramatic steepening, even as the worst parts of the economic contraction were taking place right then. Longer-term rates were rising as millions upon millions of workers across Europe and the United States and the rest of the world were being thrown out of work because it was bull steepening. And in this stage of bull steepening, the emphasis goes to the front end. Meanwhile, the long end starts to react more like the steepening. That's where the steepening takes place. And what's keeping the banks and the entire financial sector this defensive is the lack of upside growth combined with very real fears that the forgot how to grow economy, that it'll keep going and lead to further breakdown in employment. That's why banks are focusing on consumer loans and tightening standards there. They see it coming down the pipe right at them. So far, like everywhere else though, forgot how to grow has been mainly about the lack of hiring. It's been a painful absence, no doubt, but layoffs have thus far remained relatively sparse. But without any upside, with growing pressures on corporate margins and now credit in many different ways, since this has gone on so long, the danger is compounded moving forward. Economic sentiment indicators from the European Commission, for example, they have gone back down in the month of June, the latest figures that we have, suggesting that European economic participants are just as on edge as European banks are. The economic sentiment indicator for the month of June only increased to 94.0 from 93.8 in April, and it had been as low as 93.5 in December. So only a half a point pickup since the end of last year. Maybe more importantly, the employment index, that was 97.1 in June, only 0.6 of a point off of the cycle low of 96.5. And just to give you some reference here, some context, in November of 2019, Europe's employment index from the European Commission was 105.2. So the last time the EEI was this low, it was back in 2014 when Europe was coming off the 2011 and 2012 recession. And the lowest it got during the recession itself was in December 2012 at 86.1, meaning that the current value for the employment index is only 10 points off of the 2012 recession low, which means further that it's closer to the 2012 recession than the average from something like 2019. You can see why European banks are increasingly concerned about consumer loans. And all of this is consistent with Europe contributing to what the World Bank reported and projected last month when it said that the decade of the 2020s is poised to become the worst one in 60 years. This ratcheting down of economic potential that they can't seem to explain, but European banks and the financial sector, whether they know why this is happening or not, they can see it coming too. This is consistent with what markets are pricing. And what the World Bank wrote was, global growth is projected to slow to 2.3% in 2025, nearly half a percentage point lower than the rate that had been expected at the start of the year. They're blaming tariffs and trade wars for that. And while a global recession is not expected, they might want to check the marketplace. Nevertheless, as forecasts for the next 2 years materialize, average global growth in the first 7 years of the 2020s will be the slowest of any decade since the 1960s. And growth in developing economies has ratcheted down for 3 decades. 3 decades, from 6% annually in the 2000s to 5% in the 2010s to less than 4% in the 2020s. And that tracks the trajectory of growth in global trade, which has fallen off from an average of 5% in the 2000s to 4.5% in the 2010s to less than 3% in the 2020s. And what could explain all of that? Maybe something that happened at the end of the decade of the 2000s and created economic circumstances that would continue to linger on like a depression from the 2010s on into the 2020s. So the World Bank is picking up on the silent depression and saying it extends into the 2020s, and European banks and American banks and Chinese banks are saying the same thing. They're picking up on the slowdown that is consistent with depression continuing, the mistakes of the early 2020s, and thinking that the recovery period was actually recovery. In fact, that it was a red hot or even overheating economy. That consumer prices at the start of this decade had something to do with actual economics turning favorable for the first time since 2008 when That never happened. As I mentioned in yesterday's video with the crisis in Hong Kong that's developing, we're all paying for the pandemic, and first of all, the lack of upside growth and potential, because everybody thought the economy was recovering a couple years ago. They thought it was overheating, and therefore the accelerating consumer prices were proof of that. But rising consumer prices didn't mean the economy was overheating or even hot, only that the supply of goods and services globally was constrained relative to demand, and demand, real demand, that never came back all that much. But since it was rebounding faster relative to supply, prices shot upward. But the result of that weak demand recovery and the phase shift in prices produced by the supply shock was global impoverishment. Workers mainly lost purchasing power, and the vast majority of them haven't been able to get it back since there just aren't any jobs. There are no income prospects. And if global demand for goods and services in real terms never recovered, there's no need by businesses to add even more workers. But as this impoverishment drags onward, what little employment growth there has been disappears. The situation risks transitioning from that forgot how to grow dynamic into remember how to do worse. And that's what European, American, and Chinese banks and banks all over are expressly concerned about. They won't take any additional risk, no more than they absolutely have to, and it doesn't matter if central bank cuts rates. The World Bank is correct for once, and European banks in particular are agreeing with it. That is, that there's this ratcheting down effect all across the global economy, both in terms of the long run as well as in these short-term spaces. In the long run by decade, but also in the short run as we see in the German 2-year part of the curve and the bull steepening there. We had the first transition to forgot how to grow back in 2022, and then another slowdown last year in March and April that we've been pointing out ever since then. And now it looks to be another possible hit here in 2025, with places like Japan and Sweden facing re-recession, while Europe as a whole struggles just to stay a tiny amount on the good side of zero. So we have everyone from European banks to banks around the rest of the world, bond markets, employers, consumers, all of them keenly aware there is no upside to the global economy and that risks are entirely tilted to the downside, and that the world might soon forgot how to grow. And unfortunately, that wouldn't mean recovery. Of course, it's not just in Europe. Even the FOMC is beginning to fracture on the idea of lower policy rates. And we also saw a deterioration in the credit markets as well. Talked about those in the video link below. As always, thank you very much for joining me. Check out Eurodollar University Substack. There's a link in the description. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.